This is Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwagu. On the show today, Qatar finally leaves OPEC effective January 1. Niger expects GDP growth to rise to 6.5% in 2019. Plus, as part of our year-end review, our focus today is on Africa's innovation space in 2018. We start off with the markets. And after the Christmas and New Year break, global financial markets and businesses have reopened fully for business in 2019. On the equities market side, here on the African continent, most of the major markets saw losses in early trade and the first trading day in the new year. At intraday, the JSE index in South Africa took a major beating, falling 3.05%. The NSE index was down 0.67%. However, the EGX 30 in Egypt bucked the trend to tilt up 1.34%. Kenya closed year 2018 in the negative 1.11%. In the Middle East, the Qatar stock market fell at intraday, weighed down by banking shares, while most major Gulf markets slipped as year-end holidays dampened trading volumes. Qatar's index, one of the world's best-performing markets last year, with a 20.8% gain, dropped 0.18%, with Qatar National Bank falling 1.4% and Industries Qatar decreasing 1.2%. The Saudi Arabian index was down 0.29%, with the biggest lender, National Commercial Bank, slipping 0.9%, and Saudi International Petrochemical SIPChem dropping 2.4%. In Dubai, the world's worst-performing major stock market in local currency terms last year, with a 24.9% loss. The index was down 0.36%. Abu Dhabi was down 0.99%. And in Europe, shares fell at the open of the first trading day of the year as traders struggled to shake off negative sentiment that plagued global markets in late 2018. For more, Paul Christian Breeze, my colleague in Frankfurt, joins us now from the floor of the Frankfurt Stock Exchange. Hello, Paul. Good afternoon, and a happy new year to you and your team there.
Happy New Year to you.
So tell me, while some markets like Japan are still closed for the holidays, is the first trading day for many exchanges around the world. Asia has started with a hangover. How did Europe start into the year?
Well, investors here in Frankfurt specifically, but also all over Europe, were of course crossing their fingers for a positive start. But we're disappointed. When markets opened, they dropped quite significantly, over 1% or even 2% across Europe. Euro Stoxx 50 dropped a lot. Same in London and Paris, and DAX also almost 1.8%. Now it is in recovery phase. What caused this downfall this morning was the Purchasing Managers Index in China that had dropped below the mark of 50, which is an indicator for slowing growth, and that of course is a result of the trade war and the trade dispute between the US and China. So we did start off the new year 2019 as we ended off the old one, worrying over the US-China trade dispute. Now, the recovery that you're seeing behind me here in Frankfurt does not translate to all over Europe. Major indices in Europe still continue to be mostly in the negative territory.
And another worry from last year is spilling over into 2019, the U.S. government shutdown that keeps investors cautious. Are there any positive signals coming from Washington?
Well, although they're difficult to read, there is a Donald Trump tweet that is giving us a little bit of hope. He has offered to the Democrats, or said that he would want to strike a deal with them to end the government shutdown. Now, what kind of deal that would be in detail isn't quite clear yet. But what is clear is that this government standoff isn't really in any politician's interest or in any investors either. Currently, 800,000 state employees, U.S. state employees, go unpaid. Some still have to continue to work because their work is considered essential. Others have just stopped working. And all of this because Donald Trump wants $5 billion of U.S. taxpayer money to fund his wall to the border of Mexico, which, by the way, he said the Mexicans would pay for, and has thereby created this shutdown. Democrats are taking over the Congress tomorrow after successful elections last year, so they're not ready to budge to any of his requests. Instead, they feel in control and in power, and they've created a bill for spending that would fund the currently unfunded departments of justice and transportation and get the country running again. Although it's unlikely to be passed in the Senate, that is still in the majority Republican. However, if the Republicans block this, they're going to look bad because they're essentially taking these departments, these government departments, hostage to fund the wall. And that's not only going to look bad for them, it's also going to further spook investors.
All right, let's get back to Europe where you are. Italy just managed to turn the corner and avoided further conflict with the EU at the end of the year. Now, there's more bad news from the Italian banking sector. What's the latest?
Yes, Italy had just turned the corner with its new budget that won't put it at loggerheads with the European Union. Now, bad news from Banca Carige in Italy. The regional bank was taken over, or the control was taken over by the European Central Bank this morning after Carige had failed to raise 400 million in capital in late last year. It was a measure the ECB had said the bank needs to take to stabilize. It has been hit by a fraud scandal, and also, like many other Italian banks, it still has a lot of bad debt. Now, the idea was to raise capital through issuing shares, but the main shareholder wasn't quite happy about that and refused to accept the action. Now, this morning, management just resigned. A majority of management of the board resigned, and the ECB is taking this control. It now has the power to call back for another shareholder meeting and figure out what is the best solution. So, crisis averted for now. We'll see where this bank is heading. It's definitely better for the ECB to step in now than to have to worry about this bank at a later point.
Well, Paul, 2019 has just started, and I know we have quite a lot to unpack, particularly this first month of the year. And wish all of us a happy new year. Thank you for your time, Paul.